Welcome back. You're watching Closing Trades right here on ET. Now, if you talk about the Indian markets, yes, we are outperforming when you talk about the Asian peers at this point in time. But yes, the tariff tantrums are up and running. But as China and US engage in an escalating war of tariffs, China has come out with the white paper highlighting its trade relations with the United States. I have Sumita here with all the key takeaways from the white paper.
Well, after the second phase of Donald Trump's reciprocal tariffs have come into effect, and a majority of them have been slapped on China, which has crossed even 100% of tariffs on that country, China has now released a white paper wherein it states that it is ready to fight till the very end. However, it adopts a very accommodative stance wherein it says that it is ready to engage with the United States. It says, and I quote, China and the United States can resolve differences in economic and trade areas through equal-footed dialogue and mutually beneficial cooperation. In the white paper, it also claims that even though the United States and China have been long trading partners, trading partners for over 46 years. However, in recent years, in the past few years, the United States has resorted to bullying trade practices and, of course, unilateral trading practices. Remember, a trade deficit between the United States and China has crossed $200 billion, and that is something that Donald Trump wants to correct. And now that's not just in case of China, but other countries as well. But this is one of the highest. Remember, China is not just United States' biggest adversary, but it is also its biggest trading partner. So we'll have to see how that story really plays out, because both the countries need each other, especially as far as manufacturing is concerned. And China supplies a majority of manufacturing materials, including rare earths, to the United States. Let's go back and see what the white paper talks about. Well, it says that there are no winners in a trade war. China is willing to communicate, but refuses to bow. It says that China is opposing unilateral and restrictive measures, that two-way investment between the two countries has crossed to $60 billion, and that US is using tariffs as a weapon. This is an example of economic bullying. And China practices the concept of free trade and abides by WTO rules. Now, as far as China abiding by WTO rules, that has been questioned by many countries. Many countries have also claimed that it has grown at the cost of other countries, but China clarifying its stance on WTO rules. It also says that the essence of US-China trade ties is mutual benefit, and its right to development could not be deprived. We'll have to see what shape or form or direction this story really takes, because Donald Trump just a couple of hours back also stated that China is willing to talk, but they do not know quite how to, and now China releasing this white paper.
Okay, lots happening and lots of moving, paths to this market and what the world economy is going to look like. So let me welcome on board Chidu Narayanan, Head of Macro Strategy APAC at Wells Fargo, joining in on the show right now. Chidu, hi, welcome to ET Now. Thanks for your time today. While it's really about take each day as it comes, but I think it's really, the ball is sort of being passed around between China and US. What do you think is going to be the outcome of this sort of, flexing of muscles, if I can use that terminology?
Indeed. Good afternoon, and thanks for having me again. It does seem like a high-stakes game of chicken playing out on the international scene between the US and China. We believe that near term, again, this is not going away very, very quickly. The tensions between US and China run far deeper than just purely trade. Trade is a critical aspect of it, but it also stretches into other avenues such as defense and technology and global leadership as well. So the waters run fairly deep. Near term, we might see some sort of a reconciliation between the two, although it's very hard really to see where that can come from. We expect that China is likely to continue to hold on to its hard stance against the US. The retaliation, I should say, of increase of 50% of the tariffs will probably also see some sort of a commensurate measure. In addition, we also expect fiscal and monetary policy support from China onshore to support their domestic economy while it faces these external headwinds. The one thing we are fairly comfortable with is that dollar CNH is going to be heading upwards. It's not going to be a spike upwards, but it's going to be a slow grind upwards as the PBOC, the central bank in China, guides the market higher. They have been increasing the fixings for 5 consecutive days now. Dollar CNY, the onshore Chinese renminbi, trading very close to the weak end of the band, and we think that that will be grinding higher, probably to 760 or 770 by the middle of the year.
Hi, Chidu, this is Shell also joining in the conversation. I just wanted to get your view on the fact that, we've been all talking about the US equities. Do you think right now the US equities have already peaked out and this was the best that you could have with the US equities, given the fact that now you have the tariffs, you have the turmoil, you have global uncertainty? To such an extent, the Euronext CEO actually said that the United States is now like an emerging market.
In terms of equities and in general broader market sentiment, I think the biggest thing that hurts market sentiment is uncertainty and lack of clarity on what policy is. If you have some certainty, some definitiveness as to what could be coming going forward, then you can plan for it. At this point in time, we have no idea whether the tariffs last for next week or next month and how large or small they might be, which then puts investors and corporates in quite a bit of quandary in terms of planning ahead, which is really the biggest worry for markets. We expect that this uncertainty lasts for a bit longer. It's certainly likely to hurt US growth if it does last anywhere through to the course of the year. We, at this point in time, assuming that tariffs are a little sticky, expect a bit of a recession in the US, contraction in the next couple of quarters, which then feeds through to the rest of the world as well. It's unfortunately not a very pretty picture at this point in time.
Absolutely. So, one is wondering really which way the US dollar is going to help go, given the kind of sharp volatility and, weakness as well that one has seen. Many are contemplating whether the dollar has now topped out and is it not going to be the currency of choice for the world?
That's a great question. And there is a lot of nuance to the question as well. That's a question that markets and investors are grappling with at this point in time. And the way we think about it is in the very near term, say over the next couple of months, we do expect the dollar to be spiking up for a few reasons. One, tariffs on the US means that inflation on the US is going to be higher, which does not really give the central bank in the US, the Fed, too many degrees of freedom to be cutting rates. So we think the Fed is going to be hawkish very near term as it assesses the inflationary impacts of tariffs, which should support the dollar. Second, dollar is still at this point in time the predominant trade currency for the world. And this rush for dollars near term will lead to some sort of a liquidity tightness, and increased liquidity tightness in the near term should support the dollar as well. Over the medium term, though, as US growth starts to decline, probably more than anywhere else in the world, that should weigh on the strength of the dollar. And over the longer term, the questions that you raise about the predominance of the dollar in the global economy, all of those questions will start to get asked, and the strength of the dollar should start to fade away if you're talking a 5-year span. But at this point in time, near term, the dollar is stronger over the next couple of months and then quite a bit weaker through the course of the rest of the year.
Understand your view actually on the emerging markets, because when we were talking about this FII selling, the entire spree that we've had from the start of the year, you thought that the FII selling was primarily because people were choosing India versus China, and then you had a lot of them saying no, it is United States that a lot of them are preferring versus the emerging markets. Do you think that sort of a view now would have changed given the sense, the way how the tariff tantrum is moving?
Yes. So it's interesting you bring that up. It feels like it was a long time back that we had that discussion, although thinking back about it, it was probably just a matter of a few weeks. Emerging markets typically get hurt very significantly on sentiment. If sentiment's poor, there is a rush for quality, there is a rush to the safe havens. So the likes of Japanese yen, Swiss franc, and their assets do really well. In this point in time, given the support we've seen on the fiscal front from the euro area, the euro is also likely to do quite well. Emerging markets, on the other hand, are likely to face the brunt of the downside risks from all of this uncertainty and this rush for safe havens and safety. In addition to that, the emerging markets that are very heavily trade dependent, the emerging markets that are very heavily China linked, also tend to perform quite poorly. And unfortunately, Asia, particularly Northeast Asia, the trade dependent Asia, hits a lot of those boxes. For most parts of Asia, trade to GDP, which is a good indicator of how dependent on trade you are, is higher than 100%. You take Korea, Vietnam, Thailand, Malaysia, Taiwan, all of them are very trade dependent economies and part of the Asia supply chain, the global value chain that supplies to the rest of the world, which also includes China, which means that all of these countries get hit and their assets get hit, which reflects in how they performed over the past few days. The the supportive factor, maybe the rainbow in the cloud, is probably India. India being far less trade dependent, far less dependent, far less integrated into the Asia supply chain, far less dependent on US for final demand, might be relatively better off. It's still likely to be hurt, but probably less so than the likes of Korea, Taiwan, Thailand, and Vietnam. Looking for any silver linings in the clouds.
I just want to mark what's happening in the markets right now before we get back to our conversation. And fairly resilient, one would say, done, of course, with the RBI policy. Much unexpected lines. We're down about 164 odd points, and I want to see what's happening with the rest of the world, because one would say definitely we're a lot better than what's been happening across the world. Because once again, while you did have a green tick for Hong Kong and China, in fact, China held out very smartly, 1.5% higher. But that was not quite the case with Japan. It was down about almost 1,300 points. We're down only 0.5% lower. Europe as well, it's a deep sea of red out there. The FTSE MIB is down 650 points. CAC is down over 2%. That's the case with the FTSE, DAX, Stock 600 as well. And the US futures, still a little bit early, but you're seeing quiet for the Dow right now, just 6 points lower, S&P marginally higher, and in the green for the Nasdaq futures. Chidu, you were just highlighting your views on the emerging markets, and before that on the dollar as well. One's wondering what it would all entail for a country and economy like India.
Indeed, I touched upon India in my last comment as well. India, probably a little bit of a silver lining in the cloud. It's still a very dark cloud, though, with a lot of uncertainty. But India, given its much lower trade dependence, trade to GDP just about, say, 35% versus the rest of Asia, which is 100% or over. India is also far less reliant on external demand to drive its domestic growth. It's a largely domestically reliant economy. And the RBI also has several buffers to withstand external pressures as well. So probably India is a little bit more resilient, far less vulnerable to this than the rest of Asia. But that's not really saying much, given that all of us are going to be impacted with this substantial potential decline in global growth. And if that comes to fruition, then we are looking at a few quarters of quite significant decline in global activity.
Absolutely. I wanted to just understand the fact that you have a lot of uncertainty when you talk about the entire fact that how this entire tariff tantrum will go and how the sectors will react to it, how the macros will react to it. What's your view? Which would be the best asset right now to actually allocate your money into?
I'm not an equity analyst, so I'll probably stay away from the equities. On the macro front, so over a longer term horizon, treasuries, we do expect treasury yields to be declining quite a bit more. The 10-year could probably drop down to 375, 350. Near term, there is going to be a lot of volatility as markets digest the information, digest increase in inflation expectations from higher prices. Gold is another asset that is poised to do quite well, especially in the terms of uncertainty. Near term, again, reiterating that the dollar is probably higher, but over a 6-month span, we should be seeing a decline in the strength of the dollar as well, which could then lead to opportunities for particularly risk havens such as the yen to outperform. We think dollar yen is going to be having quite a bit of downside at this point in time.
Interesting. Okay, Chidu, great to have you on the show. Thank you so much for your time and your thoughts. Still pretty much a grey zone, but let's see what really comes out of this entire tariff tussle that's currently underplay amidst the world. We'll take